We come together with Kotak Mutual Fund to present for our viewers SIP Day. That's one full day of exclusive programming, educating investors, making them more aware about systematic investment plans, being the right way to creating wealth by investing in mutual funds. So as part of that programming and that packaging, we have with us a very special guest in our studios to really introduce the theme that's going to be laid out tomorrow and what Kotak Mutual Fund hopes to achieve through this event. Lakshmi Iyer, who's CIO Debt and Head Products, Kotak Mutual Fund, joins us in our studios. Lakshmi, it's great to have you on the show. We've been doing this every single year for the last 3 years, right? And the response has been very encouraging. What do you hope to send across as a message this time around to investors and viewers across the board, given where markets are and given the kind of volatility we are seeing in the markets?
No, in fact, my sense is that SIP as a concept becomes even more entrenched and much more meaningful in a market like this. So, when we started off 3 years back, it was more trying to grab the mind share or the eyeball of the investor, saying that, look, India as a country, the equity cult is very poor compared to some of our Asian peers, compared to quite a few of the developed market peers. And in that, if you say that, I'm going to stick myself to traditional mode of investments, that's not happening. So that was the first level. Now, as we see and as we've been engaging with the distribution fraternity, we've been engaging with the investment fraternity, we realize that people are now being evolved. Today, as we speak, more than $1 billion worth of SIP, 7,400 odd crores. Happy investors in the sense that we are adding folios via SIP. And now there are variations of SIP. So that's the message that we want to pass on, that if you are a first-time investor, even in this kind of a market, SIP is definitely for you. So I think that's one key message. The beauty is, by the way, let me also share with you, when I travel to B towns and non-metro cities, SIP has become like a product. It's become so synonymous. It is like Bisleri and mineral water, Xerox and photocopying. It's become very synonymous. It's not the right thing, I agree, but it's a vehicle. Mutual fund is a vehicle that facilitates SIP. People are saying that, okay, SIP karenge hum, SIP lenge hum, so that's the kind of thing. And I think it's kudos to the industry, which has been able to pass on this message as a unanimous entity, and we just kind of furthering that cause.
Yeah, absolutely, and championing it along with us. But at a time like this, Lakshmi, given the market scenario, while you can be joyous and celebrate that the Nifty is at a record, we all know what's happening to the rupee, for instance, where crude is. Or for that matter, if your portfolio has been largely skewed towards mid and small caps, I don't think you're smiling at all. Even now, even after the 1 month of a rebound that we've seen. At a time like this, what is your message to investors who are looking to balance it out, both with fixed income as well as equity?
So I think the first and the most important thing is that don't deviate from your asset allocation. This sounds very cliche, very old-fashioned, but I think old-fashioned thoughts are coming back. So is clothing. So I think it's very important not to forget those grandma's recipes. So for example, if I'm an investor with a 70 and 30%, 70 towards equity and 30 towards fixed income, because of the recent market movement, obviously equity allocation has gone up a tad, assuming this is large cap oriented. And my the fixed income is a little bit staggering. What you have to do as an investor is take that money out from equity, that portion which is beyond your asset allocation, and get into fixed income, or vice versa. If you have a predominant mid-cap portfolio, I mean, there's no reason to shy away, and that portfolio has obviously eroded in value in the near term, I think it's time to rebalance. So I think it's very, very critical not to fray away from your basic discipline. Even in this kind of a market, if I take an example of an investor like me, my investments are heavily skewed towards equity and predominantly SIP. And I've been doing this for the past 15 years. It's not just last 3-4 years. And this kind of market volatility, therefore, does not unnerve me. So I think if I extrapolate me or my kind of a portfolio to the rest of the audience, it's not very different. So I think sticking to principles, not deviating from that, even in this kind of market volatility, as I said, none of us, here or elsewhere, can really predict the market with high certainty.
No, it won't make you nervous at all, Lakshmi, because you're a fixed income person. You love rates going up. It's great for your business. You're sitting on 90,000 crores of AUM. The point is, at a time like this when there's volatility in the equity markets, when a large chunk of the monthly inflows in SIPs is being directed to the equity side of the business, how do you educate and inform and make investors more aware of saying, look, get started on SIPs, that's the first step, but also get started on SIPs within debt funds, within fixed income funds. Isn't that also a stronger message, I think, which not just Kotak Mutual Fund, but as in a mutual fund industry is taking up right now?
No, I think it's a very, very good idea. It's a fantastic thought because, while the equity culture is getting ingrained into people, the moment we talk about fixed income, people somehow have started associating it with volatility. And the moment you have something known as volatility, you have something known as SIP or an STP to help you weed out that volatility. And so, for example, we did this own analysis, the Nifty Credit Risk Index that we've been tracking, it's got a track record of almost 15 years plus. The CAGR return, if an investor did an SIP of as low as 2,500 rupees and continued that SIP, the CAGR returns over that period was close to 9%, which is not bad at all. So 2,500 rupee per month since inception, which is 2001 odd, for that index, got you about 12 lakh rupees. And if you did a SIP top up, for example, which is slightly for the mature investor or the regular investor, and just a 10% top up, that money went up to 23 lakhs, which is not bad. And that's what we also as a firm have been trying to advocate, that look, SIP is for an asset class. SIP is for removing vulnerabilities, volatilities in your portfolio and let you sleep peacefully. I think that's very critical.
Yeah, that indeed is. But for someone who wants to time the debt market, right? Someone who's looking at a very short-term view, given that the yield is already at a 2-month high, would you say now is the time to invest or go for that top-up?
See, if you, depends on which category you are investing into fixed income. So for example, if you ask me this question for a gilt fund, which typically invests in long maturity bonds or predominantly gilts, can you start nibbling at these yields at 7.93 odd % on the 10-year? The answer is probably yes. How much? Maybe 5%, 10%. But can I say with high degree of certainty, okay, look, you've put your money today, tomorrow the yields are going to come down and prices are going to rise? Very unlikely, because the situation, as you observed at the start, currency is vulnerable. So I think even if for that kind of an investor, for that category, if you were to start doing an SIP into that category, I don't think it's bad. But as I mentioned to you, if you have a portfolio which is, say, skewed or balanced in favor of fixed income and equity, if you take a slightly more conservative strategy for an SIP, would be a more prudent option, and which is why I said, a credit risk index. So you could obviously, you cannot do an SIP on the index, you could do it on any stock, fund that you like.
Okay, what about return expectations while investing in debt funds? And I think that's highly correlated to what the expectation on the yield is. We've already seen the yield hit a 2-month high.
Right.
Rates expected to go up further. So perhaps you could add some color on how investors can actually take advantage of this rate tightening cycle by investing in debt funds.
So when yields are at elevated levels, typically you see strategies like fixed maturity plans do exceedingly well. And why? Because investors get the opportunity to lock into these kind of funds. So you're mitigating interest rate risk. Fixed income cannot assure returns. But looking at the nature of the curve, for example, if you're investing in a 1-year debenture today, the yields available in the market are close to 8.5%. Depending, if you go down the credit curve, you get maybe even 9%. So if you pick up these instruments and choose, and those instruments form the underlying in the portfolio, those are the kind of returns that one could look forward to. But as I said, these are all as is where is basis, and interest rates are so uncertain, it's very difficult to predict returns on any of these strategies. So I think it's very prudent that you have a conservative outlook within fixed income, and I think a generic expectation that these strategies have the potential to outperform traditional mode of investments is the rule that you could go with.
Okay, Lakshmi, great having you in the studio, and we'll see you tomorrow at the SIP day.
Thank you
Thanks
so
so much
much
for joining
Bye.
in today.